Hi, sir. Good evening, sir.
Good evening. How are you?
Oh, I'm fine, thank you, sir. And how are you doing, sir?
Surviving.
So, if you are surviving, then what will happen to us, sir?
No, no, no. Yes.
Thank you so much for being coming over. And my dear friends, we'll start this webinar. And I'll just have a small, short background I'm going to share with what is my thought on the budget. And then I'll hand over the mic to Mr. Kant, please. So, good evening, everyone, my panelists, my friends, my colleagues. Budget 26-27 is best understood not through isolated announcements, but through its core themes, which collectively signal a maturing phase of India's economic and tax reform journey. The dominant themes emerging from the budget are policy stability, administrative reform, manufacturing competitiveness. The budget marks a paradigm shift from fiscal stimulus to structural growth, focusing on three pillars: accelerating growth, building people capacity, and third, ensuring inclusive resource access. With geopolitical tensions, trade dispute, slowing global growth, and financial market volatility forming the backdrop, the budget prioritized stability over spectacle. The economic survey lauds India growth rates as envy of the world. However, there is no bonanza but clarity and continuity. The regeneration of 200 legacy industrial state integrated program for labor intensive textile sector and the launch of rare earth corridors signal a move towards vertical integration. The FM has announced setting up a high level committee to review the financial sector to align with the Viksit Bharat growth roadmap, which was the very much was the need of the hour. The most significant taxation structural reform is the sunset of Income Tax Act 1961, which has been replaced by the new Income Tax Act 2025, which has been made effective from April 1st, current year 2026. This reboot aims to halve the volume of tax law, moving from an assessment year mindset to a single tax year structure and a simplified regulation. My friends, please join me in welcoming Mr. Amitabh Kant for the special address, a visionary who needs no introduction. As a former G20 Sherpa and CEO of Niti Aayog, he has been a primary architect of Make in India and Startup India programs, and now he's a senior advisor with Fairfax. Thank you, Mr. Kansas. Thank you so much for joining. We'll be happy to hear your thought on the total overall budget, basically. Now you're more neutral side, sir.
Thank you, Mr. Nangia. First of all, let me welcome all the participants in the discussion. And I would like to compliment Mr. Nangia for doing this on an annual basis. My view is that this budget is a budget made in very complex geopolitical times. Uh, Basically, there are three things happening in the world today. One is that the relative period of stability post World War II, since 1945, has come to an end. Uh, you are seeing a war in the heart of Europe for over 4 years. You saw a war in Middle East. And therefore, globalization as we've known it through institutions such as United Nations, Security Council, and WTO have come to an end. And United States is now withdrawing from many organizations. In fact, it has withdrawn from 66 international organizations. The second is that during the last 3.5 decades, global value chains and supply chains had lifted vast segments of population above the poverty line. It enabled almost uh, almost about 400 million people to be lifted above poverty line in China. It has enabled a vast segment of population getting lifted in various parts of Asia and in India above poverty line. These supply chains are now completely broken, and global value chains are disrupted. In the midst of all this, there is one force which is a force of huge disruption, and that is the use of data, machine learning, artificial intelligence, which is enhancing productivity in a very big way. And therefore, the use of AI has the possibility and potential to transform lives of citizens across the world. It has the possibility to lift people above poverty line. It has a possibility to improve learning outcomes, health outcomes, and nutrition. So this is a period of extreme geopolitical complexity. It's a period of great technological disruption. And in the midst of all this, the budget has been formulated, and the budget is a budget of continuity with the vision of achieving Viksit Bharat by 2047. Viksit Bharat means that we are today a $4 trillion economy, and our aim is that we should become a 30 plus trillion dollar economy by the time we become 100 in 2047. And this would mean that your per capita income, which has grown in the last 6 years at 5.6%, should really be rising at the rate of about 8.5 to 9%. And your GDP growth, your per capita growth is one thing, but your GDP must grow at rates of 8.5 to 9% year after year after year for 2.5 decades. And that is the challenge for India. So the budget, with all this complexity, if you look at the last few years' budget, the budget was based on the basic premise that most of the heavy weightlifting was done by public capital expenditure. The government capex did the heavy lifting. The objective was that in due course, private sector investment will accelerate and pick up. So the challenge for Indian economy today was to ensure fiscal discipline, ensure that we are able to crowd in private investment and not crowd out private investment. And therefore, one of the things I would say is that this is a fiscally prudent and a fiscally responsible budget, which brings down the fiscal deficit from 4.4 to 4.43%. And now, as per the new targeting of debt to GDP ratio, brings the debt to GDP ratio from 56.1 to 55.6%. But despite this fiscal discipline, the budget pushes for enhanced capex spend of taking it from about 11.1 lakh crore to 12.2 lakh crore, which in effect means an effective taking of capex spend to 4.4% of your GDP. Now, this has been an ambitious task. So if you look at the macroeconomics, it's a macroeconomically a responsible budget. It's fundamentally a prudent budget, and yet it pushes for infrastructure spending in a big way. It also focuses on manufacturing and infrastructure in large parts, and it pushes, to my mind, a very big objective of this budget has been that when you combine cities, and you need to view this in the context of last year's announcement of 1 lakh crore through a challenge route for cities, which I think will now get implemented in the next 2 months. And the new announcement of cities with 1 lakh, a 1 lakh crore fund where they will give 5,000 crore per city for economic regional development for tier 2, tier 3 cities, and then the 7 high-speed rail corridors between cities which will act as growth centers. So the objective is to link up prominent cities with high-track growth centers and drive smart urbanization in either side of this transit-oriented development. That is the objective. So you are doing high-speed train, you are doing city development, you are doing smart urbanization, and go back to 1 lakh crore through the challenge route. You are doing all this through challenge route approach. Objective is that today 46% of your population is dependent on agriculture. It is not possible for you to grow on the back of agriculture. You need to take population away from agriculture into manufacturing and into urbanization. You need to create good quality jobs. And therefore, push population into better paid jobs in cities, push people into better paid jobs through smart urbanization. That is the objective. The second key objective, as I see it, is that the budget in several areas pushes for manufacturing. It has probably the smartest move in this entire budget is that you've given tax-free exemption till 2047 for data centers. If you look at the last 7-8 years, especially the last 5 years, most of the investment that has happened in the world has happened in the field of artificial intelligence. In fact, 80% of the investment, accelerated investment, which has gone into the United States has gone into AI. And the tariffs, enhanced tariffs, have not had an adverse impact because the large flow of liquidity into AI in the United States. Now, the objective is that India has data, India has talent, and if India is able to build computing power, if India is able to build data centers, if India is able to use the power of its data to drive cutting edge technology in India, you will be the champion of artificial intelligence for tomorrow. We are at the beginning of the race today. The race is never won by the first drivers. The race is always won by those who come. If you look at the history of internet, if you look at the history of computerization, if you read the history of laptops, the race was never won by the initial inventor. And therefore, there's a huge opportunity because of vast talent. And if we are able to use it, it's a very good move. The budget also pushes for several new areas of growth. It pushes for the challenge in data centers would be our ability. India is also the only country with one grid across the country. Europe doesn't have it, America doesn't have it, and if you're able to link transmission, grid, renewable, we do about almost close to 260 gigawatt of non-fossil fuel renewables. If you're able to link up all this today with transmission, grid, renewable, nuclear, which the budget talks about small modular reactors as the base load, then you will be a champion of the world for tomorrow. And therefore, the budget lays emphasis on nuclear power, it lays budget on lithium ion cells, it lays a huge focus on critical mineral processing. It identifies Kerala, Andhra, Tamil Nadu, and Orissa as 4 places where there will be a critical corridor. And therefore, this budget drives into some cutting edge areas of growth. But I would also say that the budget has emphasis on services. It realizes the significance of education and employment. It realizes the significance of, it lays down the significance of a high level committee on education and employment. but it also spells out a high-level committee on banking for Viksit Bharat. And that, to my mind, is a very critical area because India is one country where the government debt to GDP ratio is high, but the private debt to GDP ratio is low. What is private credit to GDP is still very low at 50%. In the United States, it's 220%. In uh, Europe, it's 180%. In China, it's 190%. In Korea, it's 150%. In India, it's only 50%. And part of the reason for this low credit is a very high statutory liquidity ratio in India. With such high liquidity ratio at 18%, uh, the government uh, bonds are filled up by all these banks, and there's very little available to lend to the private sector. And therefore, there's also a need for digital banks of tomorrow. And therefore, it's to my mind, a very welcome announcement that this committee will spell out the banking structures of tomorrow. But the services sector's emphasis is also laid to the tourism sector, where a big package has been announced in terms of new sites to be developed, 15 sites to be developed, and many more things. But one of the key aspects of this budget is that sectors which were impacted by Trumpian tariffs, uh, that is textiles, footwear and leather, marine sector, all these are job creating sectors. They have a multiplier impact on jobs. And uh, therefore, my view is emphasis on these sector and support to these sectors has been critical. And this will help us in countering the enhanced tariff. My view is that this budget, if you read between the lines, there's a lot of emphasis on predictability and consistency. Uh, there's been the reform of FEMA, the non-debt instrument has been highlighted. There has been emphasis on customs reforms, which will be trust-based. There's emphasis on financial sector reforms through a high-level committee, as I talked about. And uh, there is a new income tax to be implemented from 1st April. And of course, the safe harbor rates, the predetermined rates and percentage set by tax authority that taxpayer can use for a specific transaction. And this would help us. All IT service providers have been clubbed in a single category at 15.5%, which will greatly help the global capability centers. I would merely like to say at this stage that this budget is a budget of continuity. This budget is a budget of Viksit Bharat. This budget is a budget of predictability and consistency. And this budget is a budget of, to my mind, a budget which would drive, uh, in some ways, our vision for a Viksit Bharat and accelerate that vision. There are no big bang announcements because several big bang announcements have happened outside the budget. Budget is not the only instrument. They've happened through GST, they've happened through Income Tax Act, they've happened through the amalgamation of the labor laws. And to my mind, it's a steady, consistent, predictable budget which provides continuity to the vision of Viksit Bharat as enunciated by the Prime Minister. Thank you very much, ladies.
Thank you so much for giving the insight of the economy, global insight of the global worldwide order. And thank you, sir, so much for coming over. And I hope it was a good experience with everyone watching the show, sir. Thank you so much for coming, sir. We, my dear friends, now I'll invite Mr. Mahesh Shah uh, to address us basically. He's a veteran of the Indian Revenue Service and a former Principal Commissioner of Income Tax, and he was part of the core committee for drafting new Income Tax Act. He was given CBDT Meritorious Service Award for the same. We'd like to have your views, Mr. Mahesh Shah, sir. You are there? Yeah, you are there, sir. So we'd like to have a brief view of what you think about it, overall view. We'll go into the detail as we go forward. But overall view,
Yeah,
sir.
thank you, Rakesh. Heartfelt gratitude for inviting me today for this presence for the budget, and compliments to India Anderson for organizing this seminar every year after the budget. Now, before I start, it's absolutely as Amitabh Khan has stated, it's a
So we have some
growth-oriented.
disturbance from your side, sir. We have some disturbance from your side. Yeah. No.
Am I audible, Rakesh?
No, sir, we have some disturbance, sir, from your side, sir. In the so you can just I'll invite my another guest in the meantime, Mr. Mahesha, Mr. Navneet Gol. You are there, sir?
Yes, I'm there.
Yes, sir. So, my friends, we have Mr. Navneet Goyal, former Principal Chief Commissioner of Customs and GST. He's worked in TRU of CBIC, which formulates budget proposals for IDT. His experience would be relevant in understanding the budget proposal and export promotion measures. Over to you, sir. A brief overall view of the budget, sir, before we go into the details and Q&A.
Thank you, Mr. Nangia. Thank you for inviting me for this discussion. You see, as far as indirect taxes are concerned, the good news is that there are no big bang announcements, no major changes in the duty rates. On the customs side, some exemptions have been removed, have been incorporated in the tariff, basically for better clarity. Now, when we look beyond this, there are basically all the measures can be put in 6, 7 buckets. Some measures have been taken to reduce delays, to reduce human intervention, because as we see the way India is growing and a lot of FTAs are being signed, the imports and exports would increase drastically. So we have to find a way by which clearance times can be reduced and delays can be reduced. The other is encouraging exports. Government has taken measures to encourage exports. Some measures have been taken for traditional leather sector, marine sector, SEZ areas, custom bonded warehouses. Then government has taken some measures to bring certainty into taxation laws and to reduce disputes. We can discuss all of them later, or I'll take 2 minutes to explain all of them. Then government has identified 3, 4 areas, and basically critical areas, critical minerals, aviation sector, nuclear energy, renewable energy, where customs duty exemptions have been provided to capital goods or to inputs, basically so that manufacturing facilities can be set up in the country. Then ease of doing business has been done. We know the GST rates were reduced about 4, 5 months back. And inverted duty structures, because input duties were still at 18%, but final duty rates were reduced on a host of products from 12% to 5%. A lot of money has got stuck. So government has liberalized the refund procedures, and this will help the manufacturers a lot. Some passenger facilitation measures have been taken at the airports. Because of the drastic increase in gold prices, now it is touching almost 1.5 lakh rupees per 10 grams. It was causing problem to lady passengers because the present limit was only 1 lakh rupee worth of gold could be brought duty free. Now this is causing problems. Now these things have been rationalized. They can bring 40 grams of gold. And the duty free allowances have also been rationalized. And some measures have been taken at social sector, health sector. Some cancer drugs have been, made duty free. Some diseases have been added in the duty free list. Now, in case we have time, I can explain 2, 3 minutes some of the major measures, and then we can move forward. Mr. Nangia.
So your session will already have we had these questions for you. We can go forward.
Okay.
I'll just start the panel discussion. Mr. Mahesha, you are there, sir? Mr. Mahesha. Mr. Mahesha, he's there?
I'm there, Rakesh. Can you hear me now?
Yes, yes, sir. I will ask the question with you, and you can bundle up the introductory part also. This question is for you only, sir?
Yes.
So if we start with the Income Tax Act 2025, which is becoming effective from 1st April 26.
Yes.
The budget acknowledges issues of pending rules and forms. And given the timelines which have been given by the government, how well prepared are the tax authorities, both administratively and technologically, to to implement the new act? And
Yes.
what are the implementation risks you see likely to happen there? And so aligning both acts, the biggest challenge here, you have a old act concurrently
Yes.
working with the new act. You will
Yes.
have an old filing done for the previous cases. You'll have a new filing to be done for the current cases. You'll have a
Yes.
separate legal position. You'll have a separate figures. It will be slow, and they are integrated because the common SSE. They're integrated with
Yes.
each other.
Yes.
How do has this been presumed this will work smoothly? Because when the new income tax GST came, everything came, sir, technology it is a nightmarish in the initial years. How do you
Yes.
work harmoniously between the pre-new act and the post, basically, of the same SNC with a common same PAN number? How
Yeah,
well you are prepared, the department is prepared, sir.
yeah, it is. It has been a very big challenge, and that is one of the reasons why the rules and forms have not yet been notified. So, as you are aware that we started the preparing for the new income tax bill, that has become the act now, in the last May June itself, and it was finalized it's been a long time. It's already been confirmed in July that the new act will be coming forward. So there have been committees working day and night, constituted. This is completely the work of the departmental officers. There is no outsider engaged by the revenue. So there are committees working on the forms, on the rules which are to be made as per the new Income Tax Act. And that is why, because all these income tax sections have undergone a lot of change, as we have been seeing in the last Act of 1961 and Act of 2025. That is why it is taking some time. And that is the reason why this is being implemented from 1st April 26. Although we were ready in July itself, but we postponed because all those rules, especially the system, the income tax assessment system, the ITBAs and the CPCs, they have to be modified and they have to be in line with the new amendments. And as you rightly said, that both the systems have to be unified, both the systems have to be at one. So that is why, but we are well prepared, and the Honorable FM has already announced in the budget that we will be, these forms and rules would be notified very shortly. Because as you are aware that this will all be implemented from the 1st April itself, and there would be so many forms and TDS liabilities and other requirements of the taxpayers, and the taxpayers are also required to be abreast with all those forms and rules and regulations. So we are in a very advanced stage. We have already done the work, and it will be notified very shortly.
Thank you so much for giving this clarification. But I personally feel, sir, with the two periods coming and merging together, basically, one ending, one starting, and
Yes.
totally in variation, form numbers, payments, every disclosure of information, everything.
Yes.
I personally feel, seeing the past record, it will be a very big challenge. I think we'll have to go cross this river. We have to cross this journey. We have no choice. But I hope it is a smooth process.
It is going to be a challenge, but the biggest plus point for the revenue is that there's no change in the laws.
Hmm.
So that, as if you see the 1961 Act and the Act of 2025, except of course all those provisions, the sections you call it, because we have made it the continuous exercise of the sections. So there is a sea change in the number of sections, but otherwise there's no change in the taxation structure or in the language of the Act. So that would
Uh-huh.
really help us in
Okay.
mitigating these problems to start with.
So thank you so much, sir. I have very another important question, sir. It is on the TP part, and which is on the TP safe harbor margins on IT services. I
Yes.
think I get baffled on one matter, sir. The
Mhm.
four services which were separately had a ALP have been merged together into one.
Yes.
The different
Yes.
rates of 20-24%, all odd rates have been brought down to 15.5%, right?
Yes.
And threshold पहले तो
Yes.
था नहीं जब आया तो 300 आया 300 से straight away to 2000 which is
2000
a
crores.
welcome step. I'm saying is a welcome
Yes.
step.
Yes.
I think
Exactly.
though I have no there's no question why it, and then to an automated approvals. I think
Yes.
automated approvals will be algorithm working. I don't know what it will be the working. I think there will be no human intervention, which I get it from the budget speech, basically.
Yes.
It will be
Yes.
something like a so-called faceless type of situation, basically.
Yes.
Will it be like that, sir? And it means, are you government signifying very clearly that we will end litigation into soft IT services with this coming up. Is it true?
I call it.
Why it took a long time, sir? I just only make complaint question here. Some audience that people are happy about it, but why it took such a long time?
No, because I call it a watershed moment in the Income Tax Act or Income Tax Administration. Because now, if you see, so what is happening? See, what is the priority of the government? So if you see the India, we have 65% population of India is of an age up to 35 years. We have the largest young population in the world. Now, the challenge for the government is to employ them, to meaningfully employ them, to skill them. That's why India wants to be the hub for services. And that's why I call this budget the major focus on the services sector. If you see, of course, there is so much for the manufacturing sector as well. But the major focus of this budget is on the services sector. And we are the best in the world in IT services. So it is the government's endeavor that we want to make India, the hub for the data center, for cloud services, for technological services. And that's why all these 4 different kinds of verticals have been merged in one. That is a technological service, technology service we call it. And the rate is very, very reasonable, 15.5%, that to 5 years. So for 5 years, the tax base, because see the other point, what is harming the development or the tax administration is the litigation. So now we have told them upfront that if you pay so much, there won't be any questions asked. And there are no physical or personal involvement, no prejudices, no assessing officer, no transfer pricing officer. So it's a watershed moment wherein we would completely be relying on the technology. So it's a complete technology-driven incentive. And it takes time, because what happens is for such a level of reform for all these services, and what is happening is India has a lot of potential for all these services, lots and lots of potential. For data center, we have allowed deduction for 47. It's a huge, huge effort on the government part for so many years, because to bring tax certainty about the businesses, because it involves huge investments, lots and lots of investments, lakhs of crores of rupees. The industries are investing in India. So it's a very, very watershed moment for the tax administration of India. And I'm pretty sure that it will not only lead to less and less litigation or no litigation, but also help grow the Indian economy, especially the service sector, the IT sector, which is the primary focus of the government of India.
Okay. I become Arvind. I want Arvind to come on this mic. And Arvind is a tax leader with us on taxation.
Yes,
and Arvind, you have done a lot of research on the penalty part is concerned. And the penalty provisions have been, should I use the word rationalized or not? Prosecution provisions have been rationalized, but penalty in some of the cases have been extremely deterrent, actually. It has gone up very high, basically. I want you to give a view of the penalty provisions which are there, which are going to affect my audience, which are there. It is relevant for them to understand that. And some penalty are dangerously can be applied, actually. So my dear friends who are there listening to this thing, you need to be aware of the penalty provisions. They are deterrent. They are very high. They are a little bit of have a discretion also, basically, because of fine line, actually. And there may be some practical challenge as you go forward working with the office. So, Arvind, can you give us something, a rationalization of penalty and the challenges likely to be faced by basically?
Sure. I think as we've seen 9 years of the journey of this finance minister, one thing has been very clear. I think the whole screws on tax compliance, I think they've been, they've been tightened every year. And I think so to make it more rule-based, fact-based, activity-based, and the theme we've seen again in the last 2 years is to simplify things, codify things, make them in black and white. And so in this budget, what they have said specific to assessments is assessment order, where it also relates to underreporting of income. The penalty, there would be one order that would cover a penalty provision as well. So which means there would not be a separate notice and a separate parallel proceeding. And consistent to that, what they've also said is they've also dropped the pre-deposit from 20% to 10%. Though the 10% is through a circular, the 20% was through a circular. This 10% is a big relief. That's an important change. But what they have also done is there are again several types of penalties under the income tax statute, and many of them are procedural, activity based, whether you get your accounts audited, whether you fail to furnish your tax audit report. There are a variety of things. For this, they have converted this from being classified as a penalty into a fee. And basically, they've put very clear activity based fees that is payable. So there is no concept of going on appeal, trying to say and establish a reasonable cause. All the discretion and things that were delaying an assessment, delaying a tax collection, they've all been done away with. So we are entering into a tax regime where when you file your tax return, you need to be very careful. You file a return, you better make sure that you file your return after validating all positions. They've extended the time for filing a revised return, but that also is payable with a fee. So the message that is being sent out is your return has to be filed, your books have to be closed after very, very careful, considered position. And that is coming out. And the drop in pre-deposit is an important aspect. And again, reclassification of penalty between what is a fee, which does away from the fact that it would be seen as a penalty, and where it's where it's a result of an adjustment happening in the course of an assessment, which is an under-reporting of income. You would also have to be cognizant and make sure that your assessment proceedings are handled very diligently. You don't take adjournments, or you file your submissions in such a manner that you can get you can control the penalty proceedings. Otherwise, you will have to go on appeal and then deal with them, so they've just tightened the whole procedures.
Like my audience which is there, I want to share with you very important concern which I have got it here. The penalty, when the penalty order, the order of the penalty and the main assessment merges together, basically, I don't see this you are saving anything out of it. I think there could be a lot of administrative work. Every time the demand changes, the penalty quantum will change afterward. When you can't have to collect the money, then what is the use of having a in second similar proceedings going on separately, and you have an order with it? If there's a penalty order levied by me, if the AO is doing an assessment, most likely he'll levy me the higher penalty. I may have to disclose those penalties in my balance sheets, which is not recoverable right now, which earlier were subject to litigation. It may be a disclosure in a balance sheet done by the auditors of the company. This penalty has been levied on the company. So, and there can be a little casual approach also in levying the penalty. So I think this is a practical challenge you'll find when you're closing your assessment, and when the assessment has additions, you will be worried of the penalty proceeding going on. It's another question after, if you file 10,000 appeals, there will be 10,000 orders, there will be 10,000 penalty orders proceedings going on separately. I don't know what will happen as a procedural matter is concerned, but just to let you know, I find this is a deterrent. I think what you gave a message is very important and very relevant, that the people need to be very careful about it. The penalty proceeding and the person going up to 100%, 120%, 80 to 100 to 120% is very, very deterrent. And targeting cases like unexplained investment, unexplained credits, unexplained assets, unexplained expenditure, the rate is 90, 100%. It's very, very steep. So right message, Arvind, you gave it. You need to be careful while you're filing a return. You need to give a right disclosure. You'll have to give a true and fair disclosure. Please be very, very careful on this part is there.
I'll just add one very quick observation. So even in a transfer pricing matter, if you choose a markup of 12% and you've been managing it in assessment, or rather you've been convincing the department, and then let's say this is taken at 15% should be the markup. So you straight away have a penalty on your transfer pricing markup as well. So for service companies, it also becomes important, because what is considered as underreporting for a cost plus entity is very basic. So the risks have to be assessed as we move into the new tax code effective April 26.
I will jump into after one question to the IDT, indirect taxes, GST. But one question, this is again, which has come in this budget. There have been close to 4 retrospective changes to curate procedural defects. And there are some questions, just let me give you a classical easiest case. Not being rightly being put in the documents. What happens basically, you had all the litigation going in your favor. The government has amended it and say for the sake of clarification. It does not give the date of implementation, but says for the sake of clarification. The moment you write it for the sake of clarification, does it have a retrospective effect? So all the ding cases, basically, who have been negated by this budget, and it is goes retrospective. If you won the case, you will not get a shelter of all the pending cases are concerned. So this is a very big debt trend. There have been 4 retrospective changes that has come. Maybe Mr. Shah, sir, you are aware of a couple of changes of the
Yes,
retrospective
yes,
era? Sir, can
yes.
you share with
So,
it briefly, sir?
yes, absolutely, absolutely, Rakesh. So now, what was happening? There were 4 judgments, 4 issues which were plaguing the department. I'll go to them one by one. One was that the 148 notices, the reassessment notices are required to be issued by the Faceless Assessment Unit, FAO, Faceless Assessment Officer, we call it FAO, rather than the jurisdictional assessing officer. Now I'll tell you the difference. So what is happening is the officer who is doing the assessment of a person is basically faceless because there is no identity of the officer. It is a screen-based, system-based assessment procedure we have introduced. Now, other than that, there is a jurisdictional assessing officer who is in charge of having the PAN number of the taxpayer and who does all the other works like the giving the appeal effect, rectification, collecting the demand. All other things are basically all other works are assigned to the jurisdictional assessing officer. So we call him the JAO. So there was a notification by the CBDT which stated that this 148 has to be issued by the faceless. But that was never the intention of the government because we have not empowered the faceless units for pre-assessment inquiries. So there was a lacuna in the act, and that's why some of the high courts have interpreted that since it is the CBDT's notification and the provision in the act, which specifies that it has to be the faceless assessing officer, all notices issued by the jurisdictional assessing officers, that is JAOs, are not valid reassessment notices, and they are quashed. So there are thousands and thousands of notices, and we have been doing it continuously for the last 4 or 5 years. So that is one issue which we were facing flack from all concerned because all the high courts were taking this position. Then there was also about the time limitation of the transfer pricing order because the language used in the transfer pricing, that is 92C, is prior to 2 months, 60 days prior to. So whether this would be 60 days exclusively to be left out for the assessing officer or it has to be 61 days. So there was also a problem, and there is a judgment of Madras High Court in case of Pfizer Inc. So there also it has been decided against the revenue. It has never been the intention because the idea was to allow the assessing officer 60 days, that is 2 months, to pass the assessment order. So that has been amended by the retrospective amendment, of course. Other is the time barring date where the assessment order, there is a draft assessment order, and it goes subsequently to the DRP. So some of the high courts have interpreted in Roka Bathroom and Shelf Drilling of Bombay High Court that the total procedure, including the DRP and then the final assessment order, because now what happens in case of foreign company or where there are transfer pricing additions, the assessee has an option to either go to the draft DRP, that is the dispute resolution panel, or it can be filed with the CIT appeals. So in case of DRP, it is the draft assessment order which is issued by the department, and it is finalized only when the DRP gives the instructions or the directions are given by the dispute resolution panel, then only final assessment. So demand is not crystallized till the DRP directions are received and incorporated by the assessing officer. So one of the interpretations of the High Court that the 153 time limitation includes the DRP. That was also one of the issues. Then the fourth issue was the DIN. DIN is basically what has happened is we have come out with a law that every document has to have an identification number by the revenue. So that is the DIN has to be given on each and every order. But what has happened was in some of the cases, the DIN is there, but it may not be before or after, or DIN may not have come on because of certain procedural issues. So some of the high courts have held, or ITTs have held that without the DIN being there on the orders are null and void. So all these
Sir,
four have been.
So I have
Yeah.
sorry I'm interrupting you, but it's very relevant. What happens
Yeah.
to the cases which have been closed, appeals which have been closed, where we got a benefit of the court? What happens after this amendment?
No,
Will
we
they be
will we'll file the rectification. It will be revived. So even in
so
case of
basically, sir, for my audience, it means ki, do we see something like a retrospective changes if and it suits? I'm not saying suit. Government believed it. That was the intention. Law intention से तो चलेगा नहीं sir, चलता है. So
me,
can
the
the government
point
do that? Is that a fear? If that is a fear, do you think there's a fear?
no,
Government जा सकती
actually
है.
what is happening, these all have been appeals have been allowed on technical grounds without going into the intention of the law. So the revenue's
Yes, sir.
position is that you decide on the merits of the case. We have no problems. If we don't have a case, we don't mind losing the case. But the
Okay,
point
okay.
is, just because on technical issues, on
Yes,
certain
okay,
one side of interpretation, it's not interpretation by everybody. So it's pending with
okay.
the
Well,
Supreme Court in some of the cases, it's pending with High Courts in some of the cases. But
well taken, sir.
these are, in fact, the revenues point is speaking too much in the law. Taking out every word and every comma and full stop being interpreted for technical issues. So this
I agree with you, sir.
it's kind of so nitpicking or something. So it's creating a lot of problems for the revenue for those technical issues.
So, just my friends, the time runs so fast. I was thinking we have crossed so much of time and we have got so much to talk with you. There's so many changes that has come in this
Yes,
budget. There's so much of minute thing reading between the lines, under the
yes,
lines.
yes,
There are there
yes.
there. I wish I need to have a more separate session for all of this thing. I go back to Mr. Goyal, and he being into the GST, being a principal chief commissioner of GST. So, what are the key GST amendments? Proposed under the Finance Bill 2026, what is the impact on input tax credit, refunds, dispute resolution, cross-border services? Some key points maybe which can be hit on the nail, sir. We can hit it on the head of the nail, sir.
See, the most important thing, if I say, because there is paucity of time, first is post-sale discounts. This was one area which was leading to a lot many show cause notices. Every audit team used to raise these objections. It has been totally simplified now. Now, the position is that if a credit note is raised and the recipient reverses the credit, then the supplier's valuation will be reduced, and to that extent, the tax liability will be reduced. So this has been simplified. A lot of disputes will go now. The second thing, which is an important thing, is that the intermediate service provider, location of the intermediate service provider will now be the location of recipient and not the location of the supplier. This will help exporters. This will help exporter of services, because this was again a major demand, up till now, and this is again going to help a lot of service people. Another thing which has come is because of certainty of disputes, advanced ruling authority in the GST side, the government has said that since National Appellate Authority of Advanced Ruling has not yet come, till that time it comes, they will authorize some existing authority or tribunal to hear the cases and give its ruling. If that comes, then a lot of advanced rulings will come. It will settle the disputes. Another major area is that they have simplified refunds. We know that in September, October last year, GST rates on a lot of items were reduced from 12% to 5%. But inputs for these items still attract, in most of the cases, 18%. This was leading to inverted duty structure, and a lot of capital was getting stuck in refunds. So government has said that 90% of the refund amount will be given provisionally. So this will expected to ease out the businesses, and this will be a major thing which people will welcome. This is for the GST side, major changes which I have told.
Anything more you believe, sir, is something we have time? We'd like to hear some important, like decriminalization. No, not a decriminalization.
On the
There were
custom
questions.
side, I can explain if you want.
Yes,
On
sir.
the
I will
custom
like to
side,
briefly. We would like to hear you, sir. Definitely, we'd like to hear you.
see, on the custom side, government has basically done two things. On the Atmanirbhar Bharat front, they have identified 4 areas. One is critical minerals, renewable energy, nuclear energy, and aviation sector. In these 4 sectors, they basically exempted the basic customs duty on capital goods for critical mineral processing, renewable energy manufacturing, lithium ion cells, etc. Nuclear energy, they've exempted for goods required for nuclear power plants. Aviation sector, they've exempted goods parts, components, engines required for manufacture of aeroplanes, and even raw materials if they're required for manufacture of part components, which are used for overall maintenance, etc., in defense units. So this is the major thing which we have done for Atmanirbhar, these 4 items. On the export sector again, they have tried to encourage the traditional sectors like leather sector, marine sector. In the marine sector, the major change what they have done is that if some fish is caught outside the Indian waters, in international waters, if it comes into India, it will not be treated as imports. And if it goes outside to some foreign port, it will be treated as exports. This is again a major change. That means those people will now get export benefits. Again, very positive change. A lot of disputes will go away, and this will help. Again, the marine sector will getting, they're getting specified inputs duty free at 1% of the FOB value of exports. This has been raised to 3%. In the leather sector, this benefit was going for exports of footwear. Now this will be also extended to shoe uppers. They've also done a major thing. Bonded warehouse is another area, custom bonded warehouses, which government has felt that we have a lot of potential. We can import goods from nearby countries, process them in custom bonded warehouse, and then again source back. This is one major area which government is focusing on. So what we have done is that red tape is being reduced. You can move from one warehouse to the other without custom officer's permission, although you'll have to maintain all the records, etc. This is the major change which we have done. The entire custom clearance system will now be trust-based. We are setting a digital, based system, and all trust-based with minimal, intervention from the officers. That is a major change which will come. It will take some time to set up. Then we are trying to encourage authorized economic operator scheme, AEO scheme, which basically means that you come to us, you give us your data, we'll verify you, so that when you come to the port tomorrow with your goods, we'll not take time to clear you. So we want people to come here. Tier 2, Tier 3, we are increasing the duty deferment periods. We are simplifying systems, so that basically we are thinking that when the export-import grows, and it will grow drastically in the next 5-7 years, this system, clearance system, should be digital system, and most of the people should be trusted partners, so that we don't waste time at the port. These are some of the major changes which have come.
Very good. Thank you so much, sir. These are very relevant and very important. Thank you sorry for pushing it up, basically. Shiva, you can say one important thing again, which has not been said on the customs IDT or any part of IDT, which we have not discussed till now?
Yes, sir. IDT for intermediary services, as sir was
Yes.
mentioning,
Yeah.
many GCCs are sitting on now almost 3,300 crores of refund because of the interpretation of whether it is exported or not. Now this removal of this place of supply for intermediary service will put a rest, at least for future. It will give a clear clarity that the export treatment will depend on the location of service recipient, which is outside India.
Okay.
So, but there is a flip side to this. When Indians use intermediaries outside India, this can also qualify as import of service under the reverse charge mechanism. But now this, since this intermediary as a segment has been removed from the place of supply rules, this will give clarity for GCCs, ITES companies exporting services, and also to financial intermediaries, brokers who are operating out of India. So they will get a clear clarity on the export treatment. So just wanted to add this. And
Okay.
one more thing on customs, what we expected the CIS rollout this year itself. CIS is a customs integration system, integrated system. Currently, we have IceGate, we have ICES, and we have ACES. Too many portals are there. And even the integration between GSTN and IceGate is not up to the mark. The IGST details are not flowing to the GSTN. So government is working on a single portal, which is called Customs Integration System, which will be a single portal for customs, which will really help the customs and also the importers. So that is something which is coming up in 2027, sir. And one more point, very important point, on account of FTAs. Currently, in the last 2 years, around 6 FTAs are signed by India with various countries. So it is very important for the Indian importers to validate the origin requirement, because it depends on the origination. For example, if it is the UAE or Australia, the Indian importer has to prove that it is originated from that particular country. So which is very important. Earlier, we used to rely on something called the certificate of origin, but the government has changed the concept now. Now, certificate of origin is not relevant because certificate can be obtained from any chamber of commerce in the country. So we rely more on proof of origin. So this is very important for importers to have records from the the other country to support that they were originated from that country. That is very important, sir. One more miss I would like to highlight, which we all expected in the budget, is the amnesty scheme, which people expected. There was a lot of information in the media that almost 1.5 lakh crore is stuck in customs litigations. 1.5 lakh crore, even a 50% strike rate would release a lot of money for the government instead of being fought for over many years. So that is one, sir. And one more thing, lot of impetus for bonded manufacturing, like schemes like SEZ. Now there is a relaxation. You would have heard about DTA sales getting relaxed. This is because of the US tariffs. Certain sectors operating in SEZs, they were not able to do the exports. Their capacity, they have an underutilized capacity. So this scheme, they will roll out the details of the scheme. Once it is rolled out, they may be able to get a concession on the clearance to the DTA.
Okay.
Which is a good thing. And one more thing on the AEO T2 and T3, they had a duty deferral facility for 15 days. Now this has been increased from 50 to 30 days. So for big companies with almost 500 crores of payment, even this 15 days of money saving opportunity, interest cost will be a very significant significant thing.
Thank you, Shiva. Thank you so much. In a short time, you have been able to explain so much in detail, but thank you so much for that. It was a lot of good inputs you gave us. Arvind, this is the last thing before we will end up. I have two things only. One is briefly in a minute, can you tell us about IFSC changes brought up? What changes this will lead to in IFSC, basically? And will it lead to spurt of people opening offices? Has the scope been widened? Anything you like to mention on IFSC?
Sure. I think gift cities, they've enjoyed benefits over the last few years. And this year, they've made a big sweeping change, actually. Looking at the fund, the life size of the funds that are otherwise present in Singapore, Mauritius, the competing jurisdictions, the government has actually given the tax exemption for 20 years out of 25 years. Earlier, it was 10 out of 15 years. So you've given long-term stability that for the next 25 years, if you relocate or set up a new fund in India, you don't have to pay tax in India. And they've also highlighted or brought a provision to say after the expiry of this period, your maximum tax rate would be capped at 15%. So basically, this is one final push for the funds redomiciled or funds which are outside of India to really now move into India. So whether it's an offshore banking unit, whether it's a fund, whether it's reinsurance, which is now an activity happening out of GIFT, all these will also get this benefit. So whether it's a trading desk in Hong Kong, in Singapore, whether it's a fund which is India focused fund, so there is a fresh life which is given for these activities in GIFT.
Okay, friends, this is my last question, which I'm asking my colleague Mayank Arora. Can you come on the screen, please, Mayank? Now, Mayank, he has a special knowledge on PLI, and PLI plays a very, very important role in today's economy. The incentive which the government give it. Never since independence, or I've realized the government has given in continuity such good package of incentives for putting up manufacturing units in the country. And it has been not a huge success, but it's becoming a success because it's a sort of subsidy, which is given by the center, and a lot of subsidy comes out of the state also, which is humongous. And truth is the money also comes to the company's bank account. That's a great part of it is there. So Mayank, can you tell us about first only in respect of the budget, what sectors have been included for the companies who are eligible for PLI? And the percent, not into technical, we don't need a technical discussion. We need a little bit on a little bit on it, and what sectors are likely to benefit out of it, and what is the incentive given by the government. 3 minutes.
Sure, sir. Thank you so much. So we're basically ending with what the finance minister actually started with. They mentioned the 7 strategic and frontier sectors that they have identified, and this actually flows from what Mr. Amitabh Kant was also saying in the beginning, where we have globally most of the investment coming into AI and data centers. And if you look at the sectors that have been identified, it's not by accident. The first one has to be semiconductor. So we already have an India semiconductor mission that's been ongoing, where we've now seen almost 10 semiconductor plants, albeit assembly testing and marking packaging as of now, but they have come up. So we've got that ecosystem that is going to come up now. Another one is the electronic component manufacturing scheme. So that is ECMS. Now, the amount of interest that has been shown by the industry, the government has been overwhelmed. They had allocated about 22,000 crore odd rupees in the previous budget. Now they have had to increase it by, double it to 40,000 crore rupees. And we're hoping, that they will also reopen it for newer applicants to basically apply under the scheme as well. Third and very important is going to be the capital goods that are required for manufacturing. So, like Mr. Goyal was earlier mentioning, that we have reduced the custom duty, import duty for a lot of capital goods as well. So that is, ensuring that the components that are required right now are made. But these capital goods are also going to be manufactured in India, and they want to incentivize that. So capital goods is the second last one. And the last one from this whole AI data center ecosystem is rare earth permanent magnets, where these are required in the EV, majorly for EVs. We already have a scheme that has been notified. We're awaiting the guidelines for that. But we've also got this corridor that is going to be built up for rare earth permanent magnets. Talking of corridors, we've also got chemicals that has been included, where 3 chemical manufacturing parks are going to be set up. And lastly, we have got biopharmaceuticals, right? So these are some of the key technologically advanced sectors that have been focused to ensure, that the next leap that we have till 2047, that is going to come from these sectors. And lastly, not to forget the most labor intensive sector, especially a sector that is now going to benefit after the India-EU trade deal, is the textile sector, where they've got an integrated approach now. Earlier, we were only focusing on man-made fibers. Now we've got an integrated approach for both natural fibers and man-made fibers. So, sir, these are the 7 key sectors where we've seen a lot of traction, announcements made. We just have to see now how that is going to be implemented by the respective ministries, taking the cue from the Honorable Finance Minister and the Prime Minister. Thank you.
Friends, I hate to be late. I wanted to finish it dot in time. I'm late by 3 minutes, but that's okay. But thank you so much for joining this session. I still have 2 requests. If you have any specific question coming up, please put it on the chat box. Write to us at nangia@nangia.com, and we'll be happy and glad to answer you these questions or any clarification you want to have it. And I wish I could have taken to some more finer points, but a budget of such size cannot be dissected and explained in 1 hour time. But it has been a very good discussion of it. I wish I could have spent more time. Maybe we may have some other session coming up. We'll definitely invite you. And thank you for joining this session. Thank you, everyone, for participating in this thing. Thank you.
Thank you.
Thank you.
Thank you.
Thank you.